Hi everyone, my name is Simon Mishevich from Optimize Accountants, and in this video I'm going to be rather depressing because there are so many mistakes that people make when it comes to inheritance tax planning. So let's go through them detail by detail. UK inheritance tax, what is it? Well, first of all, UK inheritance tax is a levy on the value of an estate exceeding £325,000 once you pass away, that is. And it is applied at a rate of 40%, so not to be sniffled at, on anything above that threshold. The tax is meant to contribute to government funding, but careful planning can minimise the amount of your loved ones owe when you inherit. And I guess it should say when they inherit. Interesting phraseology. So let's go through a basic example. And we'll look at a single person and a couple. And the reason why I do that is because the IHT lifetime allowance is doubled if you're married. So if you're single, you have one limit, and if you're a couple, it gets doubled up. So here we've got assets, and it's net assets. So if on a property, for instance, you may have a property that is £750,000 in value, but you have a £250,000 of debt mortgage, and the net asset value of that property is £500,000. So hopefully you can always remember that. So in this example, we've got a single person with 500,000 and a couple at £1 million. The IHT lifetime allowance is £325,000. That's tax-free money you can pass on to your children. By the way, if you're moving assets, if one partner dies in a married couple arrangement, they pass the assets to the remainder, whether husband, wife, civil partner, then that asset's passed over to them and there's no inheritance tax. Okay, so between couples, there's no inheritance tax, similar to capital gains tax for that matter. However, in the case of passing on to the children, then there's a £325,000 for a single person, and it is doubled for a couple of £650,000. What's taxable then is £175,000 for the first, a single person example, and the second example, a couple would be taxable on £350,000, being the difference of £1 million and £650,000. And the amount of tax that you pay would be £70,000 in the first example, and a couple will be £140,000. And it doesn't take a great deal of maths to work out that your net assets in these examples is more than 10%. So it's a lot of money to be paying out to HMRC, and it is costly mistakes that people make regularly, which means that the loved ones get less than they deserve or what their parents had planned. So there are a couple of things I want to go through. There's legacy mistakes that I want you to avoid and inheritance tax. Okay, so we'll hit those two subjects now. So the first one is not updating your will. Look, when you're getting married, divorced, you go with someone else as a partner, you have children, you have stepchildren, you really ought to be updating your will all the way through that journey. If you've got new assets, new business ventures, you should be updating your will. There's lots of people I speak to who say, I've not updated my will, and say, well, okay, so the house that you had was with your ex-wife, yes, okay. You're now in the house with your new partner, yes. But she's not on the title deed, she's not on the mortgage, or no, okay. Where do you think that asset will go to? Well, it'll go to her, won't it? My partner. You're not married? No. But then no, it won't. Who does it go to? Well, whoever wants to fight in court. So if you want to leave that to chance because you've not identified the people you want to have your assets when you leave this planet, then, well, don't do a will. But that is a massive mistake that people make by just saying, well, lip service, I'll do everything else that's more fun, and leave the will a mess. Which then when you pass away, people go to court because of the mistake you made. Not a good thing when they're grieving, right? So try and avoid that problem if you can. Second thing is not updating your pension letter of wishes. If you've got pensions, you have to nominate who you want those pensions to go to. But my will does that. No, it doesn't. Really doesn't. A will and a letter of wishes on a pension, completely different. It's like Jekyll and Hyde, Marmite, and, well, not having Marmite. So really, in this case, you do need to update your letter of wishes. It's so important that you do your will and letter of wishes at the same time. If you do not nominate your pension letter of wishes, to a person, then it's actually going to be subject to inheritance tax as well. So double whammy coming your way if you don't do it correctly. But those two are expensive mistakes. I'm sure you agree. No planning. Anyone that's not done a will or letter of wishes probably done a plan, and they don't understand what inheritance tax is, and they're just going to leave a huge mess. And I know some people have said on my tax calls that, well, my children will get whatever they get left. Well, sometimes you'll be surprised that they get nothing because they're paying off the debts, or they don't know what assets you have, so actually they don't get anything at all. I don't think you really mean that when you say, well, they'll get whatever they get left. But if they don't even know what pensions that are available or what bank accounts you have, how do they get those things? You're not really being clear and unfair on them. You might just leave them debts, and that is really a sore subject for them when they're grieving for you. If you want to get some international tax advice, UK or US, feel free to use that QR code. Get there. Some inheritance tax mistakes to avoid. And I've just put these points as 4, 5, 6, etc. So not making gifts within 7 years. If you make gifts within 7 years, they will be inheritance tax free. If you do not make gifts within your 7 years of death, then every bit of assets that you have will be subject to inheritance tax, and you may suffer a greater tax bill than you could have avoided. Not valuing your assets. There's lots of people I speak to and they say, oh, but my assets aren't £325,000. I say, well, what do you have? And you say, a house. I said, when did you last value it? I don't know. I bought it in 1980. It was worth 200,000. So it's not going to be subject to inheritance tax. Well, actually, inheritance tax is based on market value on death. So if you've not valued it since the 1980s, it's probably worth substantially more than what it was then. So you could have an inheritance tax subject problem that you didn't even realize it. So make sure you get all your your assets rebased at today's value to understand where you are for inheritance tax purposes. Not investing in pensions. One of the big things I always say to people is invest in your pensions, not just for retirement whilst you're alive and making sure you're comfortable, but also because pension investments are outside of inheritance tax if you have nominated someone as a beneficiary in your letter of wishes. So investing money into your pension through your limited company or through your wages will also save you on income tax, corporation tax, and inheritance tax. So why aren't people doing it? Well, because they can't access it straight away. Well, that's a fair point to make, but it's something that you do seriously need to consider. And there's that QR code again. If you need to get some advice, please book away. Point 7, trading versus investing. One of the things I say for my property investing clients is that if they've got property that they rent out, then that's an investment. That is going to be subject to inheritance tax. But if they're a property developer, as in trade, then there are ways of mitigating inheritance tax altogether if someone is going to carry on that business, which is most likely possible to do. So you want to think about, well, what business activities have I got going on that is investment that I can move to being a trade? And that's something that you can work with your tax advisor and your family to bring a true family investment company together and build wealth for the family as a whole rather than just you. Staying in the UK, a mistake that I have not I will not be subject to because I have already left. I'm in Spain. My inheritance tax will be 1%, not 40%, because I don't have many assets now in the UK. They are right here in Spain, and I'm going to save 39% inheritance tax. And that, by the way, is after €1 million, which is substantially more than the UK equivalent. So staying in the UK will cost you more in death, but also in life, because the cost of living in the UK is high. You've got higher taxes now in the UK than most places that I know. So you're paying for taxes, plus on death, your loved ones will be paying taxes as well whilst you're in the UK. So is it time for you to leave? And there is that QR code again. So if you want some international tax advice, feel free to book that right now.